Howdy, Jacob here. Today we're going to do a one-off video looking at the company Big Lots. It is in the broadline retail industry, $110 million market cap, very small, on $596 million enterprise value. They're a home discount retailer, and they were founded in 1967. I'll say when I was younger, I loved shopping here. They just had so many things on sale. It was a fun little spot. Um, Price to book 0.4. I feel like I've looked at this company before. So, okay, yeah. So the company looked absolutely fantastic up until 2023, until they caught up with themselves and realized that their expenses were growing so much faster than their revenues. And now the company's price from a stock perspective has fallen humongously. So $63 down to $4. I mean, $63 on 16 enterprise earnings per share doesn't look bad, but obviously historical looks more like should have been around 4. Not a lot of growth on the revenue side. I mean, it's almost flat for 7 years. And then we're just getting back to what we were looking at pre-COVID, essentially. Return on invested capital looked great. So for retail at 15-20% return on invested capital, it's amazing because, I mean, obviously what matters is same-store sales. But if all you have to do is build up somewhere, your store there, and you get a 15% return, it's pretty spectacular. I know when I researched Starbucks and their 30% return, it basically is like I heard a story one time where in New York City they built a Starbucks and massive return on invested capital, got money back in probably 3 years of building it. So what is that? 33% return, or effective probably like high 20%. So huge. They literally built one across the street. It was like a block and a half away. And again, 3 years essentially got all their money back on their investment with like 25% return on invested capital. Stuff like that is just absolutely insane. And so that's one thing that's good about retail. Obviously, same store sales is the biggest thing when it comes to retail, but it is great to see a high return on invested capital because then all you have to do is make more stores, and as long as you're smart about it, you get a great return and great revenue increase along with money to the bottom line. But here, this is really just going to be a comeback story. I feel like there's really not much I can do here. I'm just going to look through some of the financials and then kind of make my own assumptions, but really it's just going to come down whether they can get back to these type of numbers, I feel like. So the income statement looks fine. I mean, again, outside of the most recent 2 years, it looked fantastic, going from 125 million to 629 million over a 7-year period. Revenue, slow growth. That's what I love. People don't usually love slow growth businesses. I love them because most people don't. And so you can usually find them pretty cheap. The people say it's a dead company, but then you look at earnings and you're like, really, a dead company that's grown, 5-fold in 7 years? Pretty dead to me, right? But yeah, it looks like their revenue is dropping off and they're just not able to, their sales general admin are coming after them. The balance sheet, we see that not a lot of liquid cash here, just 45 million, and they have 301 million long-term debt, no short-term debt, 1.5 billion capital leases with 2.3 billion property plant there. Okay, cash flow. Their use of cash historically was buying back shares and paying out a dividend, and it looks like they have stopped buying back shares, stopped paying out a dividend because they've produced negative cash flow the last 2 years. And so they really had to hinder and slow down their stock repurchases and dividend payout. They're actually paying out zero now on the dividend side, which is actually great That's what you want. A company like this, you want management to figure something out to just get back to how it was. I mean, if they can get back to 200 million in cash flow, I mean, even 150 million in cash flow, that's more than the market cap right now. So if they can get back to a 10 PE on 150 million cash flow, you're looking at a $1.5 billion market cap. Even if you take into consideration debt, you're looking at a $1 billion market cap, which is almost 10 times what the market cap is currently. And so what I want this company to do if I were management, I'd want to, yes, it would hinder my revenue, but I would want to maximize efficiency as much as possible. Any location that's not doing well, sell it off. Take that cash and use it to pay down debt. So then people realize you're a debt or essentially, very low debt. They don't have to be debt free, but a very low debt company with, yeah, your assets are going to go down, your revenue is going to go down. But if you're getting rid of places that are just selling things and not making money off of them, then that's the best case for you. You need to be efficient. You need to sell a bunch of locations that are doing crappy, keep the ones that are doing fantastic. And then in the future, when you're looking for growth, just make sure that you put them in very strategic places that are going to maximize profits. All I care about is cash flow. Like, I want a company to be gushing out cash flow like crazy with little debt and having the ability to buy back shares that are stupid cheap. And if not, being advantageous with that money by reinvesting in themselves at high rates of return or paying out a dividend that if they have no other use for cash. And so that's my spiel right now. I think that if they can get back to normality, things are going to look fantastic for them. It's really just whether you think that they're able to do that or not. And so, okay, so I incorporated the figures here. So what we're really looking for is to make some assumptions here and then see if we're comfortable with them. On the revenue side, what I want them to do is to, get rid of all their crappy locations, which is going to hinder their revenue. So I'm going to say maybe that, 3% revenue growth change, because this is per year on a per year basis. Maybe in the short term, they just get rid of a lot of spots, which is going to decrease the revenue a bunch. But over the period, it'll, aggregate out. And then for margin, this will hopefully help your margin get back to just 3%. That's all we're looking at. We're seeing a low 3%. That's very conservative to me. If they do this, yes, it'll hinder their revenue, but I think that over a 7-year period, it's manageable as if their debt situation holds. I haven't looked at, I haven't done an in-depth review, so I don't know when their debt is due, but pending that they have the capability of doing that, if they sell off, their bad retail, hopefully that gives them cash to be able to pay out some of that debt. And then let's even be more conservative, 2.5%. And then maybe they don't make money for a little bit while they're being conservative, so they may have to issue a little bit of shares. And then, at the end of this period, be conservative. I'm just looking for an 8 PE. And this is going to tell you it's a screaming deal, but you have to understand the risks here. And the risk is that there's so many of them. Can they get back to these margins? I don't know. Will it take a huge hit in revenue for them to really want to do this? Absolutely. So although I'm saying it's a big deal, I'm not even going to do an in-depth review on this company, because it's really just going to be whether you think that this company can come back or not. And so there's no research I can do to guarantee you or to have like a 90% probability of them doing it. This is going to be you trusting the management to get whatever needs to be done, and then them getting back to the low end of their historical figures. And then it looks like a screaming deal. But again, can they do this? Can they get back to these figures? I don't know. That's going to have to be on your subjectivity. So I hope this helped a little bit, and hope you have a great rest of your day. Thank you.